Warren Buffett just did something he's only done before market disasters. He piled up a staggering $270 billion in cash and warned that real estate prices, pumped up on cheap money, have become dangerously unrealistic. While the rest of America is riding a wave of euphoria, convinced housing can't fall, the so-called Oracle of Omaha is quietly sounding his final alarm. What does Buffett see that everyone else is missing, and could his latest move signal a brutal housing market crash on the horizon? The numbers he's reacting to will make you question everything you know about the safety of your own home. Berkshire Hathaway's latest SEC filing lands with the weight of a sledgehammer, $270 billion in cash, sitting idle. That's not just a record for Buffett's empire. It's the largest cash reserve ever held by an American company. The number stands in stark contrast to the market's optimism, a silent rebuke to anyone convinced that the good times will keep rolling. Buffett didn't reach this mountain by accident. Over the past year, Berkshire trimmed its stakes in home builders, real estate investment trusts, and mortgage-linked stocks, quietly selling off pieces of companies like D.R. Horton and Lennar. Each move was methodical, each sale logged in quarterly reports and earnings call transcripts, each dollar stacked on top of the last. Buffett's playbook is clear. When prices become untethered from reality, patience wins. He's quoted as saying, "Opportunities come infrequently. When it rains gold, put out the bucket, not the thimble." But this is no gold rush. The bucket is staying dry and the cash pile keeps growing. In the third quarter of 2025, Berkshire's cash reserves surpassed even the levels seen before the 2008 crisis, when Buffett warned about the dangers of unchecked leverage. Behind the scenes, Berkshire's annual meeting and earnings calls echo the same message. We've kept a lot more cash than usual because many assets, including housing, are priced for perfection, not for reality. That line, delivered by Buffett himself, cuts through the noise of bullish headlines and record-high asking prices. His actions speak louder than any forecast. While Wall Street celebrates short-term gains, the Oracle of Omaha is building a fortress. The market may be brimming with confidence, but Berkshire's Cash Mountain stands as a monument to caution. For Buffett, the time to act is not when the crowd is cheering, but when the numbers finally make sense. Across the country, the mood in housing circles feels strangely upbeat. Headlines tout a rebound in builder confidence. The National Association of Home Builders Index hovers near 50, straddling the line between optimism and caution. In some Sunbelt cities, home builders sound almost bullish, pointing to steady traffic at model homes and a backlog of buyers waiting for rates to fall. But behind closed doors, the tone is less certain. The chief economist of the National Association of Home Builders admits, "We're not in euphoria. Builders, frankly, are concerned about supply chain constraints, unsteady demand, and sticky rates." Even as a few markets buzz with activity, national sentiment is more fragile than the headlines let on. Yet, a different kind of confidence is on display in the financial press. Real estate newsletters and TV analysts talk up a coming boom, fueled by pent-up demand and the supposed safety net of low inventory. The narrative is simple. As long as there aren't enough homes to go around, prices can't fall. But Warren Buffett doesn't buy it. At the Berkshire Hathaway annual meeting in June 2025, he warned, "This is a market built on cheap money and unrealistic expectations. Whenever you see euphoria, whenever the numbers don't make sense, you need to be very careful." Buffett's words land in a room that wants to believe the rally can last. His reputation is built on waiting out manias, refusing to chase what everyone else wants. "Be fearful when others are greedy," he repeats, while the crowd cheers record home prices and bullish forecasts. The gap between perception and reality is growing wider. While builders and buyers hope for a soft landing, the fundamentals tell a different story. Mortgage rates remain stubbornly high. Affordability is stretched to the breaking point, even as some celebrate, the numbers whisper a warning. Buffett's caution stands in stark contrast to the market's self-assurance, a signal that the true test may be just ahead. Mortgage rates have become the immovable obstacle for millions of Americans hoping to buy a home. In the fall of 2023, the average 30-year fixed rate crossed above 7% for the first time in 2 decades. Instead of dropping back down, rates have hovered between 6.5 and 7.5% for over a year. Freddie Mac's weekly survey now reads like a broken record. High rates, week after week, with no relief in sight. The numbers behind these rates are more than just statistics. They translate directly into monthly pain for would-be buyers. In 2019, a $300,000 home with a 4% mortgage meant a payment around $1,430 a month, including principal and interest. Fast forward to 2025, and that same home, now priced at $450,000 with a 7% rate, demands a monthly payment of nearly $3,000. That's more than double the payment in just 6 years. For many, the dream of homeownership now comes with a harsh reality check. The National Association of Realtors calculates that the income needed to buy a median-priced home has jumped to over $120,000 a year, twice what was required in 2019. Wages haven't kept up. The result is a growing gap between what homes cost and what people actually earn. This is the broken triangle of the current market: prices that soared during the pandemic, interest rates stuck at generational highs, and incomes that lag far behind. Each month, buyers run the numbers and watch their options shrink. Even small rate movements, just a half point up or down, can add or subtract hundreds of dollars from a monthly payment. For many families, that difference is the deciding factor between moving forward and giving up. The payment shock isn't just a statistic, it's the stress test that's locking out a whole generation. And as long as rates stay pinned above 7%, the pressure on affordability will only grow. Mortgage demand is now frozen at levels not seen in nearly 3 decades. The Mortgage Bankers Association reports that applications are down more than 30% compared to last year, a collapse that echoes across every region, from the Midwest to the Sun Belt. In city after city, open houses are quiet. Lenders field fewer calls. For most buyers, the numbers simply don't work. The National Association of Realtors Affordability Index sits at its lowest point since 1989. To buy a median-priced home in America, a family now needs an income of at least $120,000. 6 years ago, that threshold was just $60,000. Wages haven't doubled. For most households, the gap between what they earn and what they need has become a chasm. First-time buyers are the hardest hit. Many spent years saving for a down payment, only to watch monthly payments balloon out of reach. The average mortgage payment on a typical home has nearly doubled since 2019. Each week, more would-be buyers drop out, unable to clear the hurdle. This isn't just a story of numbers, it's a shift in behavior. Families who once dreamed of owning are forced to rent, often at rising prices. Parents delay moving for better schools. Young couples postpone starting families. In the Sun Belt, where new construction once seemed endless, early signs of trouble are surfacing. Core Logic data shows delinquencies rising in places like Dallas, Phoenix, and Tampa. Some buyers stretched to the edge during the boom are now missing payments. The freeze isn't limited to buyers. Sellers are stuck too, reluctant to give up low-rate mortgages for today's higher costs. Listings linger on the market, sometimes for months. Real estate agents speak of a market in stasis, too expensive to buy, too risky to sell. The old rules, buy now, build wealth, move up, no longer apply for millions. The system has locked out a generation, not just from homeownership, but from the stability it once promised. Wall Street's retreat from the housing market is happening on a scale that few predicted. In the first half of 2025, investor home purchases have dropped by 49% compared to last year, according to Adam. Major players, private equity firms, large REITs, and corporate landlords are not just slowing new buys. They're quietly offloading properties in markets that once seemed bulletproof. In Phoenix, Tampa, and Austin, block sales and quiet listings have become the norm. The days of bidding wars among investors are over. Instead, the focus has shifted to preserving balance sheets and avoiding a stampede for the exits. The numbers behind this exodus are striking. John Burns Consulting reports that in 2022, more than a quarter of all new homes, 26%, were sold directly to investors. These properties, many now sitting empty or rented at thin margins, make up a growing shadow inventory. Unlike traditional listings, these homes don't show up in the usual supply figures. They linger off-market, held back to prevent a visible flood that could drive prices lower. But as rental yields soften and financing costs bite, the pressure to liquidate is mounting. REITs are leading the way, selling off assets in cities where growth has stalled or reversed. In some neighborhoods, entire blocks of recently built homes are owned by funds looking for buyers. The illusion of tight supply is masking a hidden glut, thousands of homes that could hit the market if investor patience runs out. The risk isn't just theoretical, it's a slow-moving supply shock waiting to be triggered by one too many forced sales. In early 2025, a sprawling new subdivision on the outskirts of Phoenix became a cautionary tale for the entire housing market. Buyers lined up for months, drawn by glossy brochures and promises of affordable turnkey homes. The builder, a regional powerhouse that had expanded rapidly during the boom, broke ground on hundreds of lots, fueled by investor cash and easy credit. But as interest rates stayed stubbornly high and new contracts dried up, the company's financial foundation began to crack. By January, contractors stopped showing up. Suppliers demanded payment up front. In February, work stalled completely. Buyers who had put down deposits, sometimes their entire savings, received terse emails. Construction delayed, timelines uncertain, no refunds guaranteed. Some families drove past their lots to find skeletons of houses, framing exposed to the desert sun, windows missing, doors never installed. Subcontractors, owed months of back pay, walked off the job and filed liens against the properties. The builder quietly filed for bankruptcy protection, leaving hundreds of would-be homeowners in limbo. Local news documented the fallout. Families forced to renew leases, others scrambling to recover lost deposits, a few considering legal action with little hope of success. The unfinished development stands as a monument to the dangers of overextension and the fragile chain of trust that holds the housing market together. When leverage is cheap and demand is hot, risk hides in plain sight. But when the tide turns, the losses are painfully real and deeply personal. Insurance companies are leaving America's riskiest housing markets at a pace not seen in decades. In Florida, California, and Louisiana, entire neighborhoods have received non-renewal letters, sometimes with just weeks' notice. State Farm, Allstate, and Farmers have all pulled back or stopped writing new homeowner policies in large areas of these states. By mid-2025, more than 4 million homes across the country are now either uninsurable or forced onto state-run last resort plans with stripped-down coverage and soaring costs. The Insurance Information Institute calls it the largest home insurance access crisis in at least 3 generations. For those still able to find coverage, the price is staggering. Bankrate's latest survey puts the average annual premium at $2,565. Up 33% from just 2 years ago. In Florida, the median premium now tops $6,600. Some disaster-prone zip codes have seen rates double in a single year. Buffett's own companies are part of this retreat. Geico and Berkshire Hathaway Re have sharply reduced their exposure to property insurance in high-risk states. In his 2024 shareholder letter, Buffett wrote, "We price risk. We don't subsidize it." That's more than a slogan. It's a signal that the era of cheap, easy coverage is over. When insurance carriers withdraw, the consequences ripple outward. Homes without coverage can't be financed. Buyers walk away. Prices in flood and fire zones collapse as lenders refuse to touch uninsurable properties. The result is a growing patchwork of housing markets, some still stable, others suddenly stranded, with owners unable to sell or even protect what they have. June in Central Florida brings a letter that changes everything. A retired couple living in the same house for over 30 years opens an envelope from their insurance company. The message is blunt. Their homeowner's policy will not be renewed. No explanation beyond rising risk. No option to appeal. Within weeks, agents in their county report the same story. No new quotes, no alternatives, just a scramble to find coverage at any price. The couple's mortgage lender steps in next. Without proof of insurance, the bank threatens foreclosure. Forced onto the state's last resort insurance plan, their premium triples overnight. The new bill is more than their Social Security checks can cover. They try to sell, but buyers vanish when they hear about the insurance crisis. Home values in the neighborhood drop by nearly a third in a matter of months. For sale signs multiply, but few ever come down. By August, the savings they set aside for retirement are gone. The cost of insurance alone now exceeds what they once paid for their entire mortgage. In September, they pack up family photographs, box up keepsakes, and leave the home where they raised their children. Local news crews capture the moving truck in the driveway, the couple standing on the lawn, unsure where they'll go next. Their story echoes across the state, thousands of families displaced not by fire or flood, but by a letter and a price they can't pay. The house sits empty, its value erased by a crisis no one saw coming. For this family, the insurance domino didn't just tip over, it swept away a lifetime of stability in a single summer. As of the third quarter of 2025, Berkshire Hathaway holds over $270 billion in cash, its largest reserve ever recorded. The data presented shows mortgage applications down more than 30% year over year, home affordability at its lowest since 1989, and nearly 4 million U.S. homes now uninsurable or severely underinsured. Major institutional investors are retreating from the housing market, and insurance carriers are exiting high-risk states, leaving families exposed. Yet much remains uncertain. The exact depth of the coming correction and how policymakers will respond is still unknown. What is clear is that Warren Buffett's defensive posture, echoed by his statement, "We price risk, we don't subsidize it," signals a fundamental shift. The lessons of 2008 remind us. When the world's most cautious investor sounds the alarm, market realities tend to follow. The facts point to a fragile foundation, one where vigilance, not optimism, is required.